Most people think government debt becomes a problem when markets panic, when bond yields spike overnight, when headlines start using words like crisis, emergency, or bailout. But by the time you see those words, the real damage has already been done. Sovereign debt doesn't become unpayable in a dramatic moment. It becomes unpayable quietly, through years of small decisions that feel reasonable in isolation and fatal in combination. The danger isn't the size of the debt, it's the structure of the cash flow behind it. Think about how individuals actually go broke. It's almost never because of one reckless purchase. It's because fixed obligations rise faster than income, margins shrink, and optionality disappears. At first, everything still works, payments are made, credit remains available, life looks normal, but the math has already turned against them. Governments follow the same pattern, just on a larger and slower timeline. A sovereign economy doesn't fail because it borrows. It fails because the cost of servicing its promises grows faster than its capacity to produce real value. Debt is only sustainable when future cash flows grow faster than interest obligations. When that relationship flips, collapse is no longer a possibility. It's a trajectory. In the early stages, debt feels like leverage. Governments borrow to smooth cycles, fund infrastructure, stabilize employment, or respond to shocks. If a country has a GDP of $2 trillion and borrows at 2%, servicing $40 billion in interest feels manageable, especially if nominal growth is 4 or 5%. On paper, the debt-to-GDP ratio stabilizes. Politicians point to the ratio and declare victory. But ratios are abstractions. Cash flow is reality. Over time, spending commitments harden. Entitlements expand. Defense budgets become politically untouchable. Healthcare costs compound faster than inflation. Demographics shift. Fewer workers support more retirees. The tax base stops growing at the same pace as obligations. This is where the first structural fracture appears. Revenue growth slows, but expenditures are sticky downward. The government fills the gap the only way it can, more borrowing. At this stage, debt still looks safe. Markets remain calm. Bonds are rolled over. Central banks keep rates low. The illusion of control remains intact. But the nature of the debt quietly changes. Maturities shorten. Refinancing becomes constant. Interest costs become sensitive to even small rate increases. What used to be a long-term liability turns into a rolling, short-term obligation. This is not a crisis yet. It's a loss of margin. Imagine a household earning $150,000 a year with fixed expenses of $130,000. On paper, they're solvent. They can service their debt. But they have no buffer, no optionality. Any shock forces new borrowing. Any rate increase hurts immediately. They are one variable away from instability. That's what late-stage sovereign balance sheets look like. As debt grows, governments face a choice that isn't presented as a choice. Raise taxes, cut spending, or borrow more. Cutting spending is politically toxic. Raising taxes has diminishing returns. Higher taxes reduce economic activity, push capital elsewhere, and shrink the future tax base. So borrowing becomes the default, not because it's optimal, but because it's the least immediately painful. This is where the compounding accelerates. When debt reaches a certain scale, interest stops being a line item and starts becoming a system. If a country owes $30 trillion at an average interest rate of 3%, that's $900 billion a year just to stand still. Not to build anything, not to improve productivity, just to service the past. If tax revenue is $4 trillion, over 20% goes to interest alone. And that's before social spending, defense, or infrastructure. This is where debt stops being leverage and starts being gravity. Governments respond predictably. They try to grow their way out. Growth becomes the solution to everything. But growth isn't something you can command. It emerges from productivity, innovation, demographics, and capital allocation. You can't vote it into existence. And when debt is high, growth becomes harder, not easier. Capital is diverted from productive investment toward debt service. Risk-taking declines. The economy becomes defensive. This is the paradox. The more government needs growth, the more its own balance sheet suppresses it. High debt acts like a tax on the future. It pulls consumption forward and leaves less room for compounding later. Every dollar spent on interest is a dollar not spent on education, infrastructure, or research. Over time, the economy's growth engine weakens, even as obligations expand. The gap widens. At some point, markets notice, not suddenly, but gradually. Risk premiums rise. Lenders demand higher yields. Even a 1% increase in average borrowing costs can add hundreds of billions in annual interest expenses. The math becomes brutal. To cover higher interest, governments borrow more, which increases debt, which raises risk, which raises rates further. This is the debt spiral, and once it begins, it's self-reinforcing. Central banks are brought in to stabilize the system. They cap yields, they buy bonds, they expand their balance sheets. This is often framed as technical monetary policy. In reality, it's fiscal support through monetary channels. It works for a while. Inflation stays contained or appears to. Asset prices rise, confidence returns. But the underlying problem hasn't been solved. It's been deferred. When money supply grows faster than real output, purchasing power erodes. Inflation isn't just higher prices, it's the silent transfer of value from savers to debtors. For governments, inflation is attractive because it reduces the real value of debt, but it also raises nominal costs. Wages adjust, but it also raises nominal costs. Wages adjust. Entitlements are indexed. Interest rates eventually follow. Inflation is not a free lunch. It's a reshuffling of pain. As inflation becomes embedded, central banks face their own constraint. If they raise rates to control prices, debt service costs explode. If they keep rates low, currency credibility erodes. Either path involves sacrifice. This is the moment when debt becomes unpayable not because payments stop, but because every option carries unacceptable consequences. Historically, sovereign debt doesn't end with default notices mailed to bondholders. It ends with slow defaults, financial repression, capital controls, forced savings, negative real rates, pensions quietly devalued, currency purchasing power reduced over decades. The system continues to function, but the promises embedded within it are quietly broken. From the outside, life looks normal. Paychecks still arrive. Stores remain open. Markets trade. But the trajectory has shifted. The economy stops being a tool for progress and becomes a mechanism for servicing the past. Growth is consumed by obligations. Innovation slows. Social tension rises, not because people are poorer in absolute terms, but because the gap between effort and reward widens. What matters next is how this slow contraction shows up in everyday economic life, because sovereign debt doesn't stay confined to bond markets or government balance sheets. It leaks into labor markets, asset prices, business formation, and personal financial outcomes. This is where people feel confused. They sense something is off, but they can't trace it back to debt dynamics because nothing has officially broken. The first visible effect is the compression of upside. In heavily indebted systems, growth still exists, but it's uneven and fragile. Productivity gains no longer translate cleanly into higher living standards. Wages lag asset prices. Returns accrue to those closest to capital and policy channels, while labor absorbs volatility. The economy technically expands, but the experience of progress narrows. This happens because high-debt governments optimize for stability over efficiency. They protect incumbents, large institutions, and systemically important sectors because failure there would threaten the entire structure. Small businesses, new entrants, and experimentation become collateral damage. Creative destruction slows, not because innovation disappears, but because failure becomes too costly for the system to tolerate. Over time, this reduces dynamism. Think of it like a mature company with declining margins. Early on, management invests aggressively in new products. Later, when cash flow tightens, priorities shift. Buybacks replace research. Cost-cutting replaces expansion. The company still exists, still reports revenue, but its future shrinks, while its past consumes resources. Sovereign economies under heavy debt behave the same way. Another consequence is the distortion of price signals. When central banks suppress rates to keep debt service manageable, capital becomes mispriced. Projects that shouldn't be viable survive. Risk-adjusted returns flatten. Investors are pushed further out on the risk curve to maintain yield. This isn't speculation driven by greed alone. It's structural. When safe returns are artificially low, risk-taking becomes mandatory rather than optional. This environment rewards leverage and penalizes patience. Cash loses purchasing power. Conservative strategies underperform. Long-term savers feel punished for restraint. This isn't an accident. It's a feature of debt-heavy systems. Inflation, even at moderate levels, acts as a slow release valve. It transfers burden from borrowers to holders of nominal assets. Governments rely on this dynamic, even when they publicly deny it. As this continues, trust erodes quietly. Not trust in institutions in a dramatic sense, but trust in outcomes. People stop believing that effort will reliably convert into security or freedom. This doesn't lead to immediate rebellion. It leads to disengagement, lower birth rates, delayed family formation, reduced individual risk-taking, capital flight, sometimes physical, often psychological. The irony is that many of these responses worsen the original problem. Aging populations reduce growth potential. Lower entrepreneurship shrinks the tax base. Capital-seeking safety leaves productive domestic investment. Governments respond with more stimulus, more borrowing, more intervention. Each round buys time, but at the cost of further entrenching the cycle. This is why debt saturation is so hard to reverse. The solutions required are economically rational but politically impossible. Reducing entitlements means confronting demographic reality. Cutting spending means visible pain now for abstract benefits later. Raising taxes risks shrinking the very base needed to sustain the system. No elected official wants to be the one who accepts a smaller present to protect a distant future. So instead, systems drift. Policies become reactive. Crises are managed, not resolved. Each intervention is framed as temporary. Each expansion of the balance sheet is justified as exceptional. Over decades, exceptions become norms. Emergency tools become standard instruments. The system survives, but it no longer heals. From a macro perspective, the end state isn't collapse in the cinematic sense. It's stagnation with volatility. Periods of artificial calm interrupted by sharp corrections. Real growth oscillates around low averages. Living standards plateau. Inequality becomes structural rather than cyclical. Social contracts strain because expectations were built on a growth model that no longer exists. This is where historical comparisons often go wrong. People look for sudden downfalls, dramatic defaults, or hyperinflation. More often, the process looks like long periods of low growth, high debt, demographic decline, and policy exhaustion. The country remains wealthy. The institutions remain intact, but the future becomes narrower than the past. For individuals operating inside such systems, the critical shift is recognizing that the macro environment changes the payoff of personal financial decisions. Strategies that worked in high growth, low debt eras produce weaker results. Relying solely on income growth becomes riskier. Passive assumptions about pensions, public benefits, or long-term purchasing power become fragile. This doesn't mean panic or radical action. It means adjusting mental models. Understanding that the system is optimizing for continuity, not upside. That returns increasingly come from flexibility, positioning, and optionality rather than broad-based expansion. That protecting downside matters as much as chasing upside when systemic margins are thin. Debt-heavy environments reward those who understand cash flow over narratives, those who focus on balance sheets rather than headlines, those who recognize that stability can coexist with long-term decline. The danger isn't that everything falls apart tomorrow, it's that people keep playing by old rules long after the incentives have changed. At a national level, unpayable debt doesn't force immediate default. It forces trade-offs, and those trade-offs accumulate. Growth is sacrificed to service obligations. Future flexibility is exchanged for present stability. Over time, the system becomes more rigid, more centralized, and more interventionist, not out of ideology, but necessity. Eventually, the political conversation shifts. Debates become more polarized because the pie isn't growing fast enough to satisfy competing demands. Every group feels squeezed. Each policy choice creates visible losers. Trust declines further, feeding back into economic behavior and reinforcing caution and short-term thinking. The uncomfortable truth is that sovereign debt becomes unpayable long before anyone admits it. The payments continue, the bonds trade, the currency circulates. But the cost is absorbed through reduced growth, lower real returns, and diminished future opportunity. It's paid not in defaults, but in foregone potential. Understanding this changes how you interpret economic news. Stimulus isn't free. Stability isn't neutral. Low rates aren't generosity. They are signals of constraint. When governments prioritize debt service above all else, it reshapes the entire economic landscape. The slow collapse of sovereign economies is not about catastrophe. It's about compression of choices, of margins, of futures. And once you see it clearly, the question stops being when the system ends and starts being how you navigate a world where the system's primary goal is simply to keep itself alive, even if that means quietly rewriting the deal it made with everyone inside it.